All right, we're talking with Bob Utterback here at the National Farm Machinery Show. Bob, you just got finished doing the U.S. Farm Report taping here, and you made some comments about fertilizer and what's going on in the markets there fundamentally and some things looking forward.
Yes, my assumption was that fertilizer prices are somewhat tied to the crude oil, natural gas, and anhydrous ammonia complexes overall. You know, we look at the supply fundamentals in the underlying crude markets. We are setting the stages for a bottoming the oil market in reference to supply. Now, the caveat would be, will demand continue there? But my feeling is very strong that we're putting a low in this crude oil market in this $35 to $40 level. The bottom will be here coming to midsummer, and we'll start a upward thrust in the crude oil market, contingent upon how fast the global economies do recover. So the logical point would be for end users, i.e. farmers that are buying fertilizer values tied to energy. I think this fall, August, September would be an opportune time to do long-term buying up, even though last year, anybody that took that type of strategy was hurt. I think the average now that this fall will be the time to buy for 2010, because if we reduce corn acres in 2009, we could easily increase them in 2010. So
now I'm a farmer that hears you say that, and it's going to be a hard thing for me to swallow looking at some of the prices that people locked in this year and where they are now. Why is it going to be a good idea this year?
Because the fertilizer industry is basically related to natural gas and fertilizer, and as those values go up, but also the producers of P and K are basically monopolists, which means that there's few producers of homogeneous product, and they really know that they can contract and make as much money with lower supply. So there's no incentive for them to increase supply, and China is going to be a very big buyer of P and K. So there's no real reason for supply to contract, and I would argue that while we want the prices to come down, we want them to get back to the $300 and $400 arena. I think the new plateau is $5 and $6, and this leads to a much more prevalent problem agriculture has. Is I think our infrastructure costs are going to stay relatively high, and we're unfortunately getting ourselves upside down, just like the automobile industry. Our costs are high relative to demand, and if demand does contract in either export markets, feed usage, or ethanol, we have a long-term problem where we have high costs and maybe not as good a price as we saw in 08, which was a fabulous price structure.
So when farmers are locking in those prices next fall, we just had this conversation, they're protected on the price, but they may not be protected otherwise. What do they need to do to make sure they can get that product?
Well, I think, first of all, one of the problems is because a lot of retail fertilizer people really got hurt. You got to make sure that the person that you're locking in is at a financial viability. Because remember, if he would go bankrupt, you're a general creditor, and therefore that puts you in a very weak position. So you got to know who your retailer is. You got to make sure there's a good business relationship there. Secondly, you got to start putting in place now if you can get your costs locked in, and if we get a bounce in the spring of 2010, you've got to say, okay, how am I going to be a better marketer when the market gives me these prices? Every time the market gets exciting, I get emotionally difficult to pull the trigger. So you need to start integrating crop insurance, options, and futures into an organized plan that you know how you're going to operate 6 months to a year in front of the decision if a price event does come to you.
So it's managing that acre, not just managing the crop.
It's managing the bottom line, which is profit margin. And my biggest fear is costs are going to stay high and the price is going to be very variable. And we just don't know how the Obama stimulus program, the inflation, we don't know how the impact of $8 to $10 trillion is going to affect. We think it's going to be stimulated, but it could also be a tremendous raise in the interest rates, or the worst scenario is stagflation, which means we got higher input costs, but not the demand, and our profit margins are very contracted. So the warning flag is, you get $5, $50, $6 corn again on a spring, summer weather scare. What are you going to do about it so you make sure you lock in those profit margins? Like we're learning now, corn went from $8 to $3 in less than 6 months. For every 100,000 bushel you produce, you had the honor of losing $500,000.
So you're looking at planning right now, but don't take your eye off of 2010.
Don't take your eye off of 2010. We're planning that if we can get a good solid rally back into that 480 to 520 level, you need to be doing something about it. And it's not going to be an easy process, but you've got to start thinking, working with your bankers now. This fall would encourage you. You're going to think about 2010, 11. A lot of bankers got worried about margin calls last spring on hedge positions. Maybe this fall you should have a serious talk with that banker. Where is your cash flow? Where is that point where that banker is really going to get nervous? Know that point, and so this fall you go out and buy an out-of-the-money call at that point. Is that $8, $9, $10? How much of a margin call will you handle? So when you get next spring, you get ready to sell your futures or you sell your cash, you have that out-of-the-money call that insurance play in place so you have the courage to sell, and the banker has the courage to basically line that hedge for the line of credit.
Have that conversation now?
Have that conversation, I'd say, no later than September 15th. You need to have that. You need to think about 2010-11 marketing game plans when the opportunity gives at least a year before the event gives to you. You can't, but most farmers are still thinking about old crop corn in the bin. I've been down here at the Farm Machinery Show. I'd say about 30% of the farmers have old crop corn and beans to sell, and they bypass. And I would say less than 5% have more than 20% of 09 corn and beans sold. Hardly no 09 corn and beans are sold. Still holding their inventory, and they're going to hold to summer, waiting for a weather scare event to bail them out. That's called a price, not a price maker. That's a price taker. And that's, as a farmer, you don't want to be in positions where the market's got to do something to bail you out of the situation, which is, I think, where a lot of farmers are at now. We need a 50-cent bounce, a dollar bounce in beans, and we need a 30 to 40-cent bounce in corn to get things to levels where guys want to move prices.
All right, that's Bob Utterback here at the National Farm Machinery Show. For Top Producer Radio, this is Greg Benson.
That's good.